Hi, in this first lesson, we'll try to answer three main questions. What is accounting? Why do we need it? And what types of accounting are there? I'm sure you'll agree with me that these are three important questions we should ask at the beginning of the course. So let's answer the first one. What is accounting? Accounting is an information science that is used to collect and organize financial data for organizations and individuals. Okay, perfect. Let's break down this definition. First of all, we said that accounting is an information science. It is concerned with analyzing, collecting, and organizing information. But what type of information? Accounting organizes financial information. It is about money. It is quantitative in nature and measures money. Accounting isn't an abstract science. It is much more practical than theoretical. It's one of those things that you'll learn best by doing. The last part of the definition says that accounting serves organizations and individuals. How come? Well, as one can imagine, every firm needs to be able to organize the financial information related to its business. A firm has to know how much of a product it was able to sell, how much it cost to produce the product, and how much money it has in the bank. Similarly, an individual needs to be aware of their personal finances. If they don't pay attention to how much comes in and how much goes out, they may soon be in deep trouble. I think we've answered the second question too. Accounting is a science that helps us organize and represent financial information. And it helps corporations and individuals understand their finances and make decisions about the future. Accounting helps you to use the past in order to take action in the present and change the future. Pretty cool, right? However, there is one more question that we need to answer. What types of accounting are there? There are four main areas of accounting. First of all, we have bookkeeping. Without bookkeeping, we wouldn't be able to do anything, because bookkeepers are responsible for all of the information that is collected and taken into consideration. Bookkeeping is a fundamental activity, as it ensures that financial information has been gathered systematically. Then we have financial accounting, which focuses on the three main statements: income statement, balance sheet, and cash flow. It is prepared for the company's ownership, its lenders, financial analysts, and for other external stakeholders. It is highly regulated given that the information is prepared for third-party users, and they should be able to read it without having inside information. The fact that the information is prepared according to a specific set of rules renders it comparable with the one prepared by other companies, which, in turn, facilitates investors and lenders. Financial statements are prepared according to a uniform set of rules called accounting principles. The aim of these reports is to allow externals, like banks and investors, to get an idea of your business. How much sales you had? Was the company profitable? How was it financed? And so on. The third type of accounting is managerial accounting. It is available only for insiders. It is not defined by accounting principles and is in most cases more detailed than financial accounting. It contains strategic information that shouldn't be seen by the firm's competitors. Managerial accounting looks into topics like pricing, competition, marginality, budgeting, and so on. The company does not want to reveal this information to outsiders because, well, otherwise outsiders will prepare a counterplan and gain strategic advantage. Of course, managerial and financial accounting are often interrelated, and it is a frequent practice to reconcile managerial and financial accounting figures. The fourth type of accounting that we need to mention is tax accounting. This is the accounting that will determine the amount of taxes that a company has to pay. Tax accounting is a very technical field that varies for every single legislation in the world. We won't cover it in this course. In this course...
This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. This video covers the key accounting and finance positions within most large organizations. What we're going to do is take a look at each of these levels within most large companies with the idea that our focus within managerial accounting is with the controller that you'll see towards the bottom. So let's start at the top of this, what's usually called organization chart, with the board of directors. The board of directors are elected by the shareholders of the company. I'll abbreviate shareholders here, but they're elected by the shareholders of the company. So if you own some shares of stock, for example, in Facebook, you would be voting, or at least it would enable you to vote for the board of directors. The board of directors therefore represent the shareholders and meet generally on a quarterly basis, maybe more often if there are some critical issues that crop up. But the board of directors are responsible for hiring the chief executive officer. So the CEO is hired by the board of directors. The CEO essentially runs the company. The CEO is in charge of the entire company and oversees the vice presidents of various areas within the company. For example, it could be vice president of marketing, vice president of production, vice president of human resources. The chief executive officer also oversees the chief financial officer, the CFO. And now we're getting into the area that we're really focusing on with this video, and that is the CFO, who has control over all of the accounting and finance functions of the organization. So the CFO is responsible for overseeing and hiring and overseeing the controller, the treasurer, and typically the internal auditors. Although there may be some debate, sometimes internal auditors report directly to the CEO or the board of directors. So our focus is again going to be on the controller and the fact that the controller oversees the managerial accountant, which you will see at the bottom down here, the financial accountant, and tax accountant. Most large companies have each of these positions. So the financial accountants are responsible for reporting externally to outside folks like the shareholders and creditors. Tax accountant is responsible for developing strategies related to taxes and, of course, making sure that proper tax forms are filled out and submitted. But this course, and this video, is focusing on managerial accounting. The managerial accountant reports to employees inside the company and is responsible for a variety of functions, including things like preparing budgets and preparing reports related to product profitability within the company and looking back in time at variances between what they expected to happen financially and what actually happened. So there are a whole host of functions that the managerial accountant performs, and this is where the managerial accountant fits within the entire company, as you see in this organization chart.
All games such as football, baseball, basketball, etc. have rules. Playing the accounting game is no different. Why have rules? To put all businesses on the same playing field, the accounting profession has established some rules and guidelines called Generally Accepted Accounting Principles, or GAAP. Who makes the rules? The two notable organizations are the United States Financial Accounting Standards Board and the International Accounting Standards Board. What are some of the main rules? Accrual concept. Income should be measured at the time major events or accomplishments occur rather than when cash is received or paid. Revenue realization concept. The revenue realization principle requires companies to record revenue when realized and actually earned at the time goods are actually sold or services rendered. Matching concept. The matching concept matches the cost and expenses incurred with the revenue earned in a period. Accounting period concept. This assumption assumes that businesses' operation can be separated into different time periods such as months, quarters, and years. Monetary measurement concept. This assumption states that accounting measures transactions and events in money. Money is the common denominator used for reporting financial information. Business entity concept. Every business must be accounted for separately from the owners. Personal and business transactions are kept separate, not commingled. Going concern concept. This assumption assumes that the business will continue operating and will not close or be sold. Cost concept. This principle requires that most assets are recorded at their original acquisition cost, what the business paid for the asset. Conservatism concept. Revenues and gains are recognized lower in cost. Expenses and losses are recognized quicker. Don't want to paint too rosy of a picture of a business. Consistency concept. The same accounting method should be used from period to period. Differences in the operating results should result from performance, not changes in accounting methods. Comparable. Financial information must be measured and reported in similar manner by all businesses. This allows meaningful comparisons of the financial statements of the same or different businesses. Materiality concept. The significance and importance of an item should be considered in deciding what is reported. Insignificant events need not be measured and reported. Cost-benefit convention. The benefit of providing financial information should be weighed against the cost of providing it. Industry practices convention. When customary industry practices exist, they should be followed and used for financial reporting.
Hi everyone. Here we are going to discuss about quality control and quality assurance. In our last video, we discussed about what is a quality product and costs related to quality. We know that a quality product is one which is fit for purpose and conforms to specification. We discussed that there are costs related to assuring or maintaining quality. Still, getting it wrong is costlier than getting it right. Hence, effort is made to assure quality. Now, let us discuss quality control and quality assurance. Quality control. Systems for detection and correction of defects are known as quality control. Quality control is based on the concept of defect detection. The activities may include establishing specifications, standards, and tolerance for products and processes, inspecting input goods and output products, monitoring production process, identifying defective items, or identifying items that do not meet specifications, or identifying inefficiencies in process, scrapping or reworking defective items, or correcting any inefficiency identified in the process, and passing acceptable items on to the next stage. So it is set standards, monitor, identify, scrap or rework, and pass. We can see that quality control is a reactive approach. It tries to stop defective products from reaching the customer. Let's look at some of the limitations of quality control. A large number of items to be inspected in order to find defects, if any. If the whole load is not inspected and random batches are inspected, then defective items may slip through. Here the approach is reactive, that is dealing with the issue after it has occurred. Here we are locking the doors after the house has bolted. So quality control makes sure that the result of what you have done are what you expected. Quality assurance. Systems for the prevention of defects are known as quality assurance. We can see that quality assurance is based on defect prevention. It seeks to build quality into every stage of the process. So here the idea is building in quality, not weeding out defects as in the case of quality control. A buyer would prefer to find suppliers who have quality assurance process that match with the buyer's organization's quality assurance process. The aim is to work together in preventing quality failures. Quality assurance include a range of systematic activities that give the organization adequate confidence that the items and processes will be of desired quality. Quality assurance may build quality measures into product design, product specification, selection of suppliers, supplier training, employee training and development, record keeping, etc. So quality assurance seeks to build quality into the process right from the concept stage or specification stage. So it is more proactive and integrated approach than quality control. So here we discussed quality control and quality assurance. Quality assurance makes sure you are doing the right things the right way. Quality control makes sure the result of what you have done are what you expected. In the next video, we will discuss quality management and total quality management. Thank you for watching. Subscribe to the channel for more videos. Thank you.